Hi guys, welcome to Money Discourse. We've had rate rises by the Fed, Bank of England, ECB, and continued hawkish commentary. The market ain't buying it. We're in a rally mode. Huge moves in Meta and other meme stocks. Rajan, what's going on?
Yeah, it's been, I tell you what a difference a year makes. I mean, compared to last year, we're just seeing doom and gloom. And, admittedly, last year was the first real down move we've had in a long time in terms on a yearly basis. But this year started off with a bang. And like you said, we've had some meteoric rises from the low, namely Tesla almost up 100% from the low seen in January 3rd, I believe, whenever the first day of the year was. This year, we've had huge moves on that. Meta reported after close yesterday, hit a high of 195, which is over 100% move from the low seen in the prior quarter. And this is all despite all these central bankers, like you mentioned, all saying that inflation is still unacceptably high. We will do whatever it takes to get it down. We had the ECB raise rates by 50 basis points today. The Bank of England, ECB's Lagarde did reiterate that ECB, the interest rate is too high and they'll do whatever it takes to get it lower. She actually said in her press conference that next rate meeting is they intend to raise it by 50 basis points in March. And she got a lot of flack for this one comment because people are just saying, but how do you know? You have not had any projections. You have not given no star projections, no growth outlook, but you're already saying you're going to do 50 basis points. And they go, but she goes, no, we intend to raise rates by 50 basis points in March, but the intention is not a 100% commitment. The market ain't buying any of this hawkish speak out of all these central banks, and in fact are pricing in cuts. We've already seen the Bank of England, which raised 50 basis points today, is actually pricing in a cut by the end of the year. The Fed, they're saying they plan not to, they plan to keep the rates as it is right now for the whole year. But again, the market's pricing in a cut by the end of the year. The ECB as well, they're pricing in a couple more small hikes, and then that's it. So the thing is, the market ain't buying it. We've seen yields rise drop massively. Long end yields have come down so much. And those drops in long end yields are absolutely bringing a huge bid to these growth names, to these tech names. And today we've had, if we actually look at, the dynamics of today, it's a huge unwind from what the trade du jour was last year. So today, right now, we've got the NASDAQ up. The NASDAQ 100 currently up 332 points, although it was up over 500 at one point. So it has come off the low. But we got the Dow down 208. So it's been this real weird dichotomy between what is getting all the strength and what is not. And clearly, obviously, the NASDAQ's got the biggest capitalized market cap companies. So that is obviously rising all boats. That's pushing the S&P 500 higher. But within the S&P 500, the breadth is pretty similar. We've got a similar advances to decliners, but it just happens that a retail portfolio generally tends to be the stocks that got beaten down, and they're the ones going up. So retail is feeling better. But in terms of an overall diversified portfolio, it's very mixed right now. So I mean, so it's very interesting currently the way that the market is, so I mean, if we look at the S&P 500 heat map right now today, we see like Microsoft's up 3.5, Apple 2.5. So you see these huge market cap of in the S&P 500 or higher. But then if you look at the amount of red we got, I mean, the amount of red there, I wouldn't be surprised that we actually got a negative breadth today in the S&P 500, even though at one point it was up 50, 60 handles. Currently it's up 35 handles. And to be honest, I wouldn't be surprised if we start getting towards the flat line, towards the close, considering how much we've moved up and there's a lot of profit taking going on. And then we also see today that the VIX is up over 5%, and it's quite telling that VIX move when the market was up so much that the VIX was positive. So you could sort of gave a bit of a precursor to what this turnaround, what's happening right now. But again, we've seen tech up, we've seen financial services down, we've seen the consumer defensive names, obviously, as you would expect, down. The energy names, like ExxonMobil is down 4%, CVX down 2%, ConocoPhillips down over 6%, and we've seen some of these healthcare names also lower, like Eli Lilly, United Health, Elevance, Merck, who had earnings this morning, they're down 3.5%. So it's definitely a tale of two markets right now. And again, it was the big caps that led it lower, especially on the tech space, which is leading this higher. But we've got Google, Amazon, Apple after the close, three massive companies. We've had positive earnings from Netflix in terms of price action. Meta, again, for almost a 30% rise at one point. Tesla. Now, one of these have to give it up. So the question is, which one? My bet is Amazon, purely because of the dynamics in retail in general. I mean, if we look at what some of the estimates are on Amazon, they expect to report 15 cents on 145 billion in revenue, which would mark about 5.8% growth in revenue. But again, the real thing that's pushing these stocks higher in the face of Meta anyway, they lowered their Capex and they announced a $40 billion share buyback. And again, the actual numbers weren't great. Their EPS missed, their revenue growth was pretty paltry. Their daily active users were pretty much flat year on year, but it was the cost cuts that really pushed us higher because, again, that was what pushed it lower in the prior earnings. Facebook's, well, Meta's Reality Labs is still hemorrhaging money, but I think in Amazon, they've still also got a cost issue. They've opened up so many warehouses for fulfillment, and now they're trying to shut it down. You've seen job cuts out of Amazon. But again, that's my bet. Apple, to be honest with you, they haven't warned, they haven't done any job cuts or anything, which suggests to me that they're going to have a good number. So I wouldn't be surprised if Apple had a good beat on both the top and bottom line. And Google, all the talk, we actually had the creator of Gmail, and he was in an interview saying that Google search will be irrelevant in 2 years' time with the emergence of ChatGPT and the way that ChatGPT and potential developments from that will revolutionize search from just a list of items from a search query to actually giving answers, and just the way they're doing it is all different. So Google will be very interesting to see if they address it at all in any way. What their answer to ChatGPT or just AI in general is in their earnings. But again, I would expect the earnings to be decent enough. But again, yeah, I don't think it's going to be a blowout. But I think two will be positive, one will be negative. My bet is Amazon will be the negative one, and Apple and Google will react positively. What do you say?
Yes, I mean, there's some reports on Twitter. Amazon has surpassed 2 million option contracts traded today. 71% of those are calls. So yeah, we've seen a big pull off relatively from the highs today. So the market makers bullying things around. Moves like this don't happen from the retail traders, right? It's the big guys who are moving things. And BlackRock have a 5.4% stake in Tesla now.
They have a stake in Baidu as well. They've shown big stakes in quite a few of these companies. Baidu was up 9% on I think yesterday on the BlackRock stake. So it's interesting.
Yeah. These guys are just buying at the lows, and when you start seeing reversals like the Tesla, I mean, just seeing it in one month how much it's gone up, but then you saw the reverse pretty much from end of November down to early Jan. We saw the opposite. So it feels good to have a rally like this, but like Radin says, you have to kind of be wary and even Elon Musk is warning. Yeah, in turbulent times.
Again.
Yeah. So just hold your horses, guys. I know, like, sometimes you might feel like this is the low. It might be a low. Essentially, the Fed doesn't really want to see the markets rally this much, and you never know. You might see some of the Fed members start coming out like a bit more hawkish to try to calm things down. They don't want people feeling rich when their portfolios go up, and the narrative behind that is obviously they want to keep inflation from basically undoing all of their good work. Where's this going to go? Are we going to just consolidate? I know, Rajan, you've got this feeling that 2023 is going to be a consolidation year.
Yeah, I mean, if you look at it right over time, we've had since 2009. If you look at the actual long-term chart, it's pretty much been an upwards trend for such a long time, and then we had this one little blip downwards, and in the grand scheme of things, 2022 was nothing in the grand scheme of things. But there are many periods like we had in the 90s where we just chop back and forth and we don't really go anywhere. And so I wouldn't be surprised to see a time where we have a lot more chop. So this year started positively, but I cannot see any fundamental reason other than because the Fed ain't going to go start drastically cutting rates, right? So the thing is, it's more that they're just stopping. And I think now, but we already knew this. We already knew their terminal rate was around 5%. So they've got to 4.5 to 4.75%. So maybe a couple of 25 basis point increases more maximum if needed. But again, it really depends on the data now. A lot of these central bankers are all talking about being data dependent. So now tomorrow's non-farm payroll, that's going to have a big significance, and everyone's looking at the wage cost index. So we did see Fed members coming out, Jerome Powell noting that they will be looking at the wage cost index. So clearly wage inflation is a cause for concern for the Fed. And on top of that, just the general inflation numbers as well, especially the core. We know that commodity prices have all coming down, but it's the services prices, the wage inflation, which is becoming embedded. So the question is after a certain point, how much lower can this inflation go towards their target if those things don't subside a bit? In that aspect, I think, again, like I've been saying last year and this year, that all of these rallies, I'm just trimming. Like, I will rather have some cash, even if we continue to go higher, and then so be it. I'm still long delta. I have plenty of positive long delta in my portfolio. So even by taking profits on the way up, rather have it in the hand than in the bush, like they say. A profit in the hand is worth double what it is in the bush, or whatever it is, that thing. But I mean, if we look at the S&P just right now, if you actually look at it again, so even though it seems like we've had a big rally, which we have, the market's just been going sideways since July last year. We've only been going sideways, but again, it's individual stocks that have given a lot more stress than the overall index. If you were just playing the index, you're not actually stressing that much, especially the S&P 500. So, and if we actually go back, the past 5 years, I mean, if we look back to 2013, and this is what I'm saying, since 2009, 856, almost, what's that? That's like almost 6 times increase. And then this is the move down we had in 2022. So if you look at it in the grand scheme of things, it's not really that much of a big move, and now we're sort of consolidating over here. So this, if we look at this level over here, which was around 2,500, we got to a high of 4,750, and then we almost went down 50% from that pivot to pivot. Just doing a bit of ballpark maths right here off the top of my head. So that was a 50% retracement, and now it looks like we're forming an inverse head and shoulders. So we could see a little bit more, but fundamentally, I don't see any reason why we should be going massively higher, especially anywhere near like the highs that we got last year, purely because none of these companies, especially the big ones that led the market, they're not growing. They're not growing. It's just you're seeing these big snapback rallies off a very low base. Like Meta again going to as low as 88, Tesla going to low as 100, and so for those reasons, you've seen quite clearly it was a massive overreaction to the downside. Now we're going back up and now going towards a value area. Now I think it's much harder, obviously, to get from like 200 to 300 as it was to go from 100 to 200. So again, so I think it's to be picky, especially at these levels. What we at the beginning of January, there's a lot of buying opportunity there. And again, when the market's falling like that, that's when you want to be buying. But when the market is rallying the way it is, and especially individual stocks, I'll be much more wary of buying on this type of move than I was like a month ago or a couple of months ago. So
you saw like Michael Burry, saying sell. But
and he's on Twitter. I heard he's on Twitter.
Yeah. Then he deleted his account. And then we've got your boy Buru. He's a bit more bullish now on a lot of his plays. What was your thoughts on Meta and their massive increase? Just looking at it a bit more fundamentally, like the metaverse cost Meta $14 billion, right? In terms of a loss.
If I were to look at Meta, right, and you just look at some of the metrics, so they reported a Q4 EPS of $1.76. That was almost 40-cent miss of estimates. Like a normal time, that would tank a stock, and their revenue was slightly above it. But look, this was the big thing. They announced a $40 billion buyback and cut their Capex forecast for next year by about $4 billion. So, that was a pretty big thing. But if you look at the core metrics, their daily active users, up 4% year on year. Their monthly active users were up 2%. But the biggest thing was their advertising revenue was down 4% on a constant currency basis. And their operating margin went 20% from 37% last year. So that's almost a halving in their operating margin. So there is no reason why this stock, other than it was smashed down and it was a bit of a relief, and then the cost cutting measures that will obviously help that up margin, recover a bit. But the type of move this has had fundamentally, I would say around here, I'm not saying, the thing is the market momentum plays a big part, and a lot of people jump back on board as the name of it. But in terms fundamentally, by this particular quarter, it was not a good quarter, to be honest with you. And then if you look at their CFO comments, they may incur additional restructuring charges as they continue their efficiency efforts. So when a company is trying to grow, when the company is cutting back costs and streamlining and everything like that to raise earnings rather than earnings from a top line growth perspective, then that is always a time where you're not in the growth phase of that company anymore. And so they're taking this big bet on the metaverse. And if that plays out, that could be their new growth avenue. But right now, they're not growing, but they've cut costs. That's what the market wanted. So I don't think it was that great, but clearly the market liked what they heard in terms of the cost cutting, and that's why we have this move right now. So
you know what's interesting? A month or two ago, when crypto was crashing, you thought, okay, it's the death of crypto, and now you see all these coins like just going absolutely bananas. And it seems like when the momentum is there, it just changes people's mindset.
It's the next best thing since sliced bread. This is it. Like, I went long Meta, like you. At around 100, and today I just sold out everything I had. And the thing is, it could go higher, of course it could, but I'm like 90%. And that one thing I said to myself, if I get 50 to 100% gains in a short amount of time, I'm out. I don't care if it goes 200-300% over 5 years. Like when I'm getting these quick gains, because when it was the meme stock time in 2021 and I saw 100% gain, I was like, hey, you know what? I want 200, I want 300, and that screwed me over massively because someone actually messaged you? Yeah, saying App Harvest is up 300%. 300%. Well done. Oh, I'll show you what App Harvest did. Went down from 40 to 80 cents, and it's gone from 80 to 240. So, like this is just what it is. This is the way I'm playing it. Like, obviously, the market has loads of different participants. Everyone plays it totally different. But from what I've learned in the past, you get a 90% gain quickly. I don't know. I'm done with that one. Especially considering looking at that report. Like if they were growing and they beat on the top and bottom line, they had good operating margins. All right, then that's a different. Maybe I'll trim some of it, but that's
you have to look at where's the future catalyst. I mean, it's like with Tesla. There's so many things in the future that could raise the valuation multiple times, like the bot for self-driving, etc. But what does Meta actually have? And really, how bullish do you have to be on this metaverse playing out and then them to be the leader and no one else can catch up? I don't know. Like you said, very tricky. I think I'm going to trim down half my position and just let the rest ride. So I'm just playing with house money in that respect. But with Microsoft, we had earnings there and they're very bearish on the outlook. But the thing is, Microsoft's a monopoly, right? And they're seeing all the antitrust going on with Google. And I think they're trying to avoid that. But the main thing that's bullish with them is integrating with OpenAI, ChatGPT. And look, they've just released a Teams premium model, which for $7 a month, you can integrate ChatGPT within Teams. So, it can do a lot of the things for you if it's just like a personal assistant. Integrating working AI models like ChatGPT with, your productivity tools that you already use. It's going to get better and better.
I mean, that was the one good investment. It was a good investment by Mike. The real question is, how well can they integrate it? How well can they take a lead using this technology and try to get one over before the competition all catches up or create their own one? We already heard that. I think it was Baidu that creating their own chat GPT, but it'll only be used with people in China. But one thing with Microsoft, and it was a trend with Microsoft, AMD, and Intel was a horrible earnings. We saw that. AMD reacted very positively, but again, it wasn't the best. I wasn't like, it was a slight beat on the top and bottom line. The guidance was pretty light, but again, it wasn't considering the move it's had lower. AMD reacted positively to it. And I think considering what happened to Intel, it got a positive read of that. But it was just that with PC demand is impacted Microsoft, it impacted AMD obviously, and Intel the most. But AMD does see a rebound in that demand going forward. But with Intel is just a dog with fleas. It's I've never seen an Intel report that bad. I mean, they actually guided their next quarter EPS negative. I can't remember the last time they made a loss. Just incredible. But this is where they are right now. Intel has been a fallen angel by far.
With Google, I know there's advertising headwinds that they've been facing on iOS. I think that they might potentially underperform, but again, I think that the market's going to be happy with.
Is there any read through from your app? Like, are you seeing any advertising trends? Is it recovering, or is it still what it was before?
Yeah, I see rates have gone down quite significantly in Q1 this year, especially from Google. And I was looking historically, they're paying a lot less than they have been previously. So it's not them paying out specifically. They run auctions for every ad request that you send. So all of the bidders are willing to put in their highest bid, and it takes that. So it's not Google who are in control, and they haven't changed any of their rev shares that they have with publishers, and they're still like pretty much the highest in the game. But in terms of what the market is actually paying for ads at the moment, it seems to be less. I mean, I'm not too sure if there has been a higher trend, moving to CTV or whatever. But in terms of the banners that we run, we've seen lower ECPMs throughout on both of the apps on our geo, and I'm looking at reduce rates even on third-party providers as well. It looks like in some cases come down like 80%. So yeah, the advertising market isn't looking fantastic right now, but as we see inflation cool off and inventories pile up, I'm sure that advertising is going to pick up, and we'll see hopefully in Q2, Q3 things start picking up on that front. But yeah, in how that affects Google, obviously they take a rev share of the auctions that take place. If my app is a reflection, then it seems like they're not performing as well as it would be if we weren't kind of constrained by high rates and fear of a deep recession, because obviously ad budgets are the first things that get cut when it comes to this type of thing. So, well, we don't know if the Fed's decision right now and that market outlook and the rallies that are going on right now are going to affect advertiser sentiment. But yeah, we'll just have to see.
Well, anyway, the market's closing around 20 minutes. This pod's obviously going to go out after these guys all report results. But bear in mind, this was just prior to it, we've seen Amazon probably and Google outperforming. Amazon up just around 6% right now. Google is up around close to 6.5%, whereas Apple has actually been the underperformer. Apple was just up about 2%, 2 and a bit percent prior to their earnings. But then again, Apple's declined the least from the high, so it's not having the huge snap moves like Amazon, which is almost halved at one point from that high. It went down to like 81. It's now 111 or something. So it's been a pretty nice move off the low. But yeah, it'll be very interesting, and they're going to set the tone. They will set the tone massively for the coming weeks, I would thought.
If you guys follow us on Twitter, you see Raj has been posting how well the Money Discourse portfolio is going. So
yeah, so feel free to close out a Lucid, closed out I put on a Bed Bath & Beyond punt. I try to put just all the information, some of the movers that are all happening in the morning, some of the macro news, some of the news that I think that moves some of these stocks and stuff like that. So definitely feel free to give it a subscribe, as well as on YouTube as well. Please like and subscribe if you like what you hear. It'd be great. And and we'll see how these earnings are, and on the next podcast, definitely we'll go talk over them and see the impact they will have, and where it leads us for going into next quarter.
Yeah, and let us know what you guys want in future episodes. Do you prefer shorter, more condensed episodes, or this half an hour plus type episode that we normally shoot out to kind of give a more comprehensive outlook on the market every week? So just let us know and comment below. Follow us on Twitter, like and subscribe, and we'll see you guys in the next one.